Welcome everyone, and thank you so much for joining today's webinar. We're going to go ahead and get started. I'm Renika Lightborn with Advanta IRA, and I'm really excited today to be joined by my colleague, Corey Dehash. Thank you so much, Corey, for co-hosting with me.
Of course.
So in today's segment, this is where you get to ask us pretty much anything relating to self-directed IRAs. In addition, we'll kind of cover our most commonly asked questions, what we typically get when we're helping someone with self-directing. Corey will also give us a unique perspective from his previous experience as an account manager. So it's good to kind of get the back end of what that will look like for you as a client. If you have questions, definitely feel free to type those in the question box. We will answer those questions throughout as they come in, and also to allocate some time at the very end if additional questions or if there are additional questions. Again, I'm Renika Lightborn. I'm one of the business development specialists here at Advanta. I'm located in the Atlanta office. I've been with Advanta as an employee since 2019. I'm also an Advanta client prior to joining the staff. So I also actively self-direct my retirement account as well. If you have any specific question, you can always reach out to us. Definitely feel free to give us a call and or send us an email. Check out our website. I will allow Corey to officially give his introduction, his background.
Yeah, thanks, Renika. My name's Corey Deharsh. I've been with Advanta since 2016. Just until recently, I've served as a client account manager for Advanta, which is the personal liaison you have when you actually open an account with us. So in my experience, I've processed thousands of transactions in various different categories, such as private placements, real estate investments, hard money loans, basically anything you can do with a self-directed account. I've seen it over my 5 years working with the company. As of recent, I've actually moved out of our main headquarters in Tampa, Florida to Asheville, North Carolina. So I am joining Renika and the staff out of our Atlanta office as I work to generate some new business and help the investor community in the Carolina and Tennessee regions. Again, I'm new to the area, so if any of the participants here today are in Carolina or Tennessee, please reach out to me if you've got any investor groups that you think would benefit from Advanta's knowledge and wealth of experience, or if you have any specific questions as well. I just want to jump into a brief disclaimer. Advanta and its employees do not endorse any specific products or investments, and we do not convey investment advice as a self-directed IRA administrator. All materials that we will be using today and information we'll be using today are for educational purposes only, and we do implore you always to consult with your own CPA, attorney, financial advisor, or any other professional that you would need to conduct due diligence before placing any specific investment. There are a few takeaway points that I just want to highlight before we get into the brunt of the PowerPoint today. Basically, any IRA account or former employer plan, if you've worked in the school system or a government agency that you no longer work for, can be self-directed. So you can take that money and move it into a self-directed account for your own investment purposes. Self-direction is a way that you can invest and choose the specific investments you are in instead of only electing a number of portfolio profiles from a more managed style account. And also, all of the expenses and all of the income of your self-directed IRA investments are due back into the IRA account directly. So anything that you earn or any expenses you have for your IRA's investments all filter right back into the account, either tax-free or tax-deferred, depending on the status and style of account you have self-directed. A little bit about what we do at Advanta. Again, we've been in business for about 20 years now. Our staff does have attorneys, certified IRA service professionals, and self-directed IRA professionals. Of our existing clients, we have just over 1.5 billion in assets under management. Any assets, any funds that are not currently invested in an asset with Advanta are secured up to FDIC limits. And as I alluded to earlier with my previous position, When you have an account with us at Advanta, one of the key things that stands us apart from our competitors is we have a dedicated client account manager, which is your personal liaison to your investment account and the investments you'd like to make. That personal account manager will be able to answer your questions, assist you with getting proper protocols in order for investments you'd like to place, and help talk through some scenarios. Again, we're not providing legal advice, tax advice, or financial advice, but we can certainly walk through scenarios with you and help you do your best to stay within IRS protocol and understand the rules and regulations around these self-directed accounts. Renika, I do see a question that's already popped up here from Randy Smith. Is UBIT tax an issue with the Advanta SD IRA? Randy, we will get into UBIT tax a little bit more thoroughly in the presentation. It's not necessarily an issue, but it does come into play with certain types of investments. So we'll talk about it later. I just wanted to let you know that we're not ignoring you. It will be a topic that gets brought up during the presentation here shortly.
Perfect. Thank you so much, Corey. So in addition to providing you that concierge style service that Corey referenced in terms of having a dedicated account manager, we also are very committed to providing you a pretty robust educational platform. Part of our commitment with educating the public about self-directing includes hosting webinars such as this. Today we're doing it in-house, taking it back to the basics, the generals about self-directing. But also too, we have featured guest speakers on a recurring basis. So for instance, next Tuesday, we have Doug Smith, who's going to be covering note investing. And next Thursday, I'm going to be co-hosting a webinar with David Randolph looking at talking about short sale investing. So if it's something that's of interest to you, definitely feel free to attend next week's webinar. Also too, we have a networking event, our online networking event, Pitch, Promote, Prosper. We do it every other week. Every other Friday. So we actually have one this week, and it's just where you have the opportunity to join like-minded investors to network, where you kind of give your pitch, pretty much your haves and wants. All of our webinars are recorded, so you can always, again, check out our website, look at our video library. The videos our recordings are uploaded to YouTube within 24 to 48 hours. You can certainly, if there's something of interest to you, refer back to the different content. Also to our blog, it's a great resource. It has everything, the latest and greatest as it relates to the self-directing industry as a whole, the news, the trends. So definitely feel free to visit our blog. So one of the most common questions I typically get when I talk to someone who's relatively new to the term is pretty much why haven't I heard about self-directing? Again, that's not uncommon. The most common IRAs pretty much are held by your banks and your large brokerage firms, and we know their business model is stock, bonds, mutual funds. But in reality, the IRAs say that, hey, you can use your IRA funds to invest in pretty much a long list of opportunities, and I'll highlight some of the different investment options available to you. So we know that there's trillions of dollars sitting in retirement accounts, but in actuality, only less than 4% is self-directed. So again, it's a great opportunity for you to be able to take a proactive approach to invest, to self-direct your retirement account. You might be asking yourself, why do people choose to self-direct? I'll highlight just, 3 common reasons as to why someone may self-direct, or why you may choose to self-direct. One, it can be a new source of capital for you. Like Corey referenced, if you have an old TSP or an old 401k, you can elect to roll those funds over into a self-directed account where you don't have to, tap into your personal savings or take out a bank loan. You can put those old 401k funds to work in your next investment. Another reason as to why someone may choose to self-direct is the volatility, the ups and downs in the stock market. Today it's up, tomorrow it's down. Sometimes, no one can really time the market, but just dealing with the fluctuation, if that's not your forte, you don't have to pretty much be in the stock market. With self-directing, it gives you the ability to truly diversify your account. Today we're going to look at some case studies, mostly focused on real estate, but a lot of times when investors self-direct, they have real estate holdings just because we know real estate always holds some value. So not having to be tied up in the stock market and deal with those fluctuations. Another benefit as to why someone may self-direct is because of the tax benefits, having those rents and those profits, those dividends flow back into the retirement account, tax-free or tax-deferred, just depending on the type of account that can be self-directed. In terms of the different types of accounts that can be self-directed, just know that any type of IRA, so whether you have a traditional IRA or Roth IRA, if you are self-employed or you have a side business or a side hustle, you can look to self-direct a SEP IRA, a simple or a solo 401k. A solo 401k is very similar to a traditional 401k that you would have at a W-2, but the solo 401k is specifically for entrepreneurs, business owners. If you do want to know more about that, definitely feel free to give us a call and we can kind of talk about in greater detail. Any former employer plan like a 401k or 403b or TSP can be self-directed. If you have children, you can certainly look to self-direct a lesser known account like the educational savings account. Recently, we've seen an increase in clients opening up HSAs, health savings accounts, to cover medical related expenses. So again, any type of IRA can be self-directed. The key takeaway or the key thing to remember is just knowing that the contribution limits between the different types of accounts varies. And then of course with your Roth, the distribution is tax-free at retirement as long as you've had the Roth account for at least 5 years.
So I've got a few Q&As here on this slide, more or less than going over the exact Q&A. I would like to just go over how to get started with a self-directed account. So the first question here basically is, what if you have accounts with other custodians and you want to basically consolidate or pool a lot of those funds together for your self-directed investment strategy? Well, you can do so. The main thing to keep in mind is that all pre-tax accounts can typically be rolled into a pre-tax account that is self-directed, but anything that is Roth status or post-tax would have to remain separate in its own bucket per se as a Roth or post-tax account. The second question here is a very commonly asked question. Can spouses share an account, or siblings, family members, etc., that plan to invest self-directed together? The literal term IRA does reference individual retirement arrangement or individual retirement account. So it's not possible to actually hold an account jointly together, but you can invest your funds or your investment with someone else in a specific deal. It would just be your retirement account co-investing with the significant other or friend, business partner, their own individual retirement account. So again, getting started, you can roll money from previous existing plans as long as they are the same type of account as far as a pre-tax or a post-tax account. 401k funds can be rolled into traditional IRAs. Roth IRA accounts can be moved into a self-directed Roth, and you cannot split an account with someone. However, if you each have a self-directed account, you are able to co-invest into any of the investments you may be considering handling through the self-direction avenue. As far as how much a client has to move to a self-directed account, it is not an all or nothing strategy. There is no minimum that we require for you to have a self-directed account. I have clients that will fund the account with just a minimum $100 deposit while they forecast their investment opportunities and plan ahead so that they are, maximizing the interest they're earning on the money before they're actually ready to put it towards a self-directed deal. Most investors do come into self-direction with either a deal in mind or at the very least a specific investment strategy that they're doing their due diligence on. So again, getting the account open and started does not require you to move all of the money you expect to invest. You can just start the account with a minimum deposit just to get it up and running. And when you move forward with the actual investment or ready to move forward, that's when you can move the actual funds that you are going to utilize for the deal. We don't have a required minimum balance. So at any point that you invest the full amount of your Advanta account into an asset, it's not like you have to replenish any sort of cash or amount of cash into the account. That asset in itself would show as your Advanta account balance until anything changes with that deal.
Okay, so in terms of the different types of investment opportunities available to you, when it comes to self-directing, just know it's when I tell you it's literally near universal in terms of the things that you can use your IRA to invest in, specifically for real estate related assets. If your focus is single family home, so whether it's going to be a fix and flip project, or if you're looking to do rentals. So again, whether it's it's a long-term buy and hold or short-term. I actually just did a recent webinar a couple weeks ago with Rich Monroe talking specifically about short-term rentals. You can certainly use IRA funds to invest in the likes of condos, mobile home parks. If you are a passive investor, a lot of times, you can look to use IRA funds to invest in the likes of REITs, or say a syndication where you're just, investing in a multifamily unit or a commercial property. Whatever your preferred strategy is, if you want to invest in a physical, tangible real estate, these are some of the options to you. If you're looking to, not specifically hold physical real estate, you just wanted to be a paper investor, you can look to invest in the likes of notes and mortgages. Your IRA can actually be the bank where you're, a private lender. When investing in notes, you can do, partial notes if you choose to. You can do wholesale or assignment of contracts, accounts receivables. The list goes on and on. You can literally get to be as creative as you want to or need to. In terms of some other alternative assets that's available to you, your IRA can invest in LLCs. And Corey, we're going to look at a case study where you get to use LLC feature. You can use IRA funds or retirement funds to invest in the likes of heavy equipment, farm animals. I know right now cryptocurrency is a hot topic. We did a webinar on that as well. So if that's an interest for you, you can certainly use IRA funds to invest in that. Oil and gas, the list goes on and on. And I do see a question that came in referencing banks and brokerage companies have common trust funds and mutual funds to get diversification in securities market. How can investors with a small amount get similar diversification in real estate market? That's a great question. So again, with real estate, you can be a passive investor. You can simply look to pool your funds, invest in crowdfunding or in REITs. You can, use a smaller amount to invest in, say, you do an assignment of contract, wholesale. There's options for you. My colleague did a webinar on that. I would definitely say check out our YouTube channel if you have a smaller account, in terms of how you can use those funds to invest in real estate related assets. But again, you can do assignments, you can do tax liens or tax deeds, depending on which state. You can be the bank. You can lend something as small as $500 or $1,000. It's up to you. So just get started. It doesn't have to be a large amount.
Renika, thanks for getting to Adrian's question there. So a lot of clients will ask about their self-directed investments and basically the legitimacy or the question about, is it guaranteed? Is it, all on the up and up? Well, basically, as I alluded to in one of the top slides with our disclaimer, we do not sell any investments or recommend any investments. So everything a client does, it is their responsibility and due diligence to invest into, per the term self-direction. The due diligence is something that you can do with your own CPA, attorney, tax preparer, legal advisor, or counsel, and the vesting of the investment you hold is actually in the name of your IRA account and goes through the trust tax ID number for the IRA company as custodian, meaning Advanta, so that there's no taxable liability going back to an individual client themselves or any discrepancy with the investment being held by the client as an individual. So basically, the investments are not guaranteed. It is still investing. So it's, your own due diligence is what does the deal for you. If it succeeds, then that's great. If it doesn't, that is sometimes the case scenario. So it's always important to make sure you fully vetted either a property, a loan where you're the lender and you're vetting the borrower, whatever it may be. It is fully your discretion to do that due diligence. And again, the Advanta client account manager will help in making sure that all of the appropriate reporting, documentation are named and coded correctly in the IRA's name, as to avoid any personal liability or issues with the investment that you take place. A lot of clients ask us if they can invest outside of the US, whether you are a person that lives outside of the US part-time or have relocated to the US from another country. I have seen plenty of clients either invest into specific assets outside of the US, and actually a decent amount of clients look to invest into real estate. I've seen a lot of clients invest into real estate in South American countries. This is not limited on the IRA's side of things. You are allowed to invest internationally. The real due diligence you want to do if you're considering international investments is with the country and investment provider that you're looking to work with. A lot of those South American countries have specific stipulations where the investment must come from either an entity that's been set up, like an LLC, within the state or country of question. A lot of investments outside of the US, let's say, for example, a Canadian investment in a syndication, you may have to look ahead of time to see if your IRA money needs to be converted to the Canadian foreign currency before and or after the investment is funded and ready to pay out any disbursements. Keep in mind, any investment you're making outside of the US will have these types of requirements. So it's part of your due diligence as the self-directed account holder to just check up on the rules and regulations in that country of question. Contributions versus earnings. Basically, you're able to contribute a certain limit per year. Depending on what type of account you have, that limit may be higher, as Renika alluded to earlier, for accounts that are set up for solo managed companies or small owned companies. Retirement accounts that are traditional or Roth IRAs currently have a contribution limit of $6,000 with a $1,000 catch-up limit if you're over age 50. But those are completely different from your earnings that you generate when you are actually doing active investments. So there are higher funding limits for those types of 401k plans and self-directed plans that are SEP simple IRAs. The traditional and Roth IRAs have lower contribution limits, but again, if you're looking into tax deferred or tax-free accounts, that would be when you're actually paying the taxes when you're making your contribution, and then all of the earnings that you generate from the initially contributed funds are growing at a tax-free or tax-deferred basis, depending on the style of the account that's been opened. I'm sorry, I saw a question come in from Abbas. I just wanted to read that out. That's kind of why I got distracted there for a second. If I want to pool funds with another family member to buy a property, is it better to do with a multi-member LLC? Abbas, that is your discretion to either buy the property directly as a split account property or to set up the LLC. I just want to address that. I will go into more depth on that question in one of my case studies towards the end of the presentation. So just letting you know, I'll put a pin in that. That is a brief answer that you can do it either way. I'll go over a little bit of the pro and con during my case study for you. And back to the slide. How do I know this is allowed? The IRA was enacted to allow clients to invest into self-direction, and the ERISA Act created back in 1974 basically allowed these types of investments to take place. IRAs are governed by the IRS, although created by ERISA, they're not governed by the same exact laws. What we typically refer clients to if they're asking for specific due diligence on an investment strategy or a specific investment is IRS Publication 590 and Internal Revenue Code 4975. You can typically find those very easily by searching just the IRS's website. And I'll tell you, as a client account manager, I have referred back to the IRC 4975 countless times. It's a very, very resourceful piece of information and documentation for an investor that'll kind of give you good details of what you can and cannot do. And it's very easy to read if you go looking for a specific portion of it. The IRS's website's really great about having sublinks so that you can click on a specific topic and jump right to a specific portion of that Internal Revenue Code that you'd like to review.
Thank you so much, Corey. So we highlighted some of the many things that you can do when it comes to self-directing in terms of being, as creative as you want or need to. To Corey's point, the IRS do have a few restrictions that you do have to adhere to. So in terms of the only two types of investments that your IRA cannot purchase is life insurance and collectibles. Collectibles is anything like antique art, wine, stamps, coins. Obviously, some coins are allowed, and that's based on the actual trading value of that metal. That's pretty straightforward. The other restriction that the IRS has in place, and this is typically where we get most of our questions, is who the IRA is not allowed to transact with, a prohibited transaction. So the IRA is not allowed to transact with someone who's considered a disqualified person. A disqualified person would be you as the account holder, your spouse, your parents and grandparents, so lineal ascendants. The IRA is also not allowed to transact with your children or grandchildren or any spouses of your children or grandchildren, so lineal descendants. The easiest way to just think up and down the ladder, lineal ascendants, lineal descendants. The IRA is also not allowed to transact with any business or entity that's owned or controlled by a disqualified person. And when I say transact, it just simply means that the IRA is not allowed to be on the opposite side of the table from a disqualified person. An example of that would be if you personally own 123 Main Street, you can't sell it to your IRA, or you can't take money from your IRA and lend it to your spouse or your child or your business. Again, opposite sides of the table, and the eyes of the IRS, that's prohibited. However, the IRS do allow you to partner with yourself or your or any person, including your spouse or child or parent. Meaning, as long as you're sitting on the same side of the table, it's perfectly fine. An example: say you wanted to, again, real estate base, you wanted to go out and buy that property. If you decide to put money in as an individual, you own and control your IRA, but you do have to think of it as its own separate person, its own separate entity. But you put money in personally, your IRA put money in, and you purchase that property together. It's fine because you're both sitting on the same side of the table as buyers. The key thing to remember is whatever the IRA puts in, the IRA has to get back. So in that scenario, if the IRA put in 80% of the money to purchase that property, the IRA is entitled to 80% of the profits. Obviously, the profits flowing back into the IRA will be tax-free or tax-deferred, depending on the type of account that you have. And then for you, if you're the other party involved in that deal, then you will receive the remaining 80%. In that case, too, the IRA would also be responsible for its share of the expenses. So in this case, if it's 80%, then it'd pay 80% of the expenses, like say property taxes, or you got to pay a contractor or insurance. The key thing is when partnering with a disqualified person, you can't change the percentage of ownership. It has to remain the same throughout the life of that investment.
Thanks,
So now we're
Renika.
going to transition and take a look at a couple case studies. I'm trying to see if any other questions came in.
No other questions, but I did have one piece of information I wanted to piggyback on your reference to the disqualified persons. Just for an example, and I say this because I hear this question a lot. If you own a property within your self-directed IRA account, it would be disqualified or prohibited for one of those disqualified persons to be your tenant. So if you own a property at 123 Main Street, you cannot have your son or daughter be the tenant at that property. You'd be surprised how many individuals do want to buy properties for their family members to live in, but that is not allowed.
Yeah, thank you so much, Corey. And also too, same thing with just to add to that, in terms of sweat equity, you're not allowed to do any of the work on that property. You get to oversee everything, you get to decide what needs to get done, but you can't physically pick up the hammer and do any of the work.
Thank you, Renika. Yes, I always refer to real estate investments as you can serve as the general contractor, but you have to be that general where you're subcontracting out all of that labor and all of the different things that you're doing. Now, let me jump into case study number 1. In case study number 1, I'm going to cover what it looks like to invest into a piece of real estate with a self-directed IRA account. I'll kind of start answering some of Avis's question about what would be better for investing in property with a family member in this case. So let me just give you guys the basic details. Sorry about that. So we've got an investor named Paul who has about $150,000 to make an investment. He's already been researching and forecasting real estate, and he expects to spend $100 on a piece of real estate that needs about $20,000 of repairs to get it rent ready. And once it is rent ready, he expects to receive $1,500 a month of rental income that will go straight into his IRA account. So what it looks like to actually complete this transaction, Paul would need to open up an account within Advanta. He would find the investment property he wants to invest into, make the offer to purchase, submit the purchase paperwork to his Advanta IRA representative, that client account manager, and he'll have to mark all of the purchase paperwork as read and approved so that we, as Advanta, on behalf of the IRA account, are authorized to execute the investment transaction, fund the closing, and process the actual wire that will fund to the title agency for closing on the property. It is pretty simple in this case. As soon as Paul lets his client account manager know that he wants to invest into real estate, we can send out a detailed instruction email that outlines exactly what needs to take place. And we also have a separate instruction email we can send directly to the closing company or title agency so they know what their involvement is and what the requirements for the closing would be on behalf of the IRA account. Again, that's part of that personal liaison and client account management that we offer. Advanta will execute the paperwork again only after Paul marks everything as read and approved. We will send the funds out to the closing agency, and then we will follow up and make sure we receive the recorded deed holding the IRA as the owner of the property, and then we will coordinate those $20,000 worth of expenses for the property to get updated with the different vendors. So either Paul or the vendor would send the invoice directly to Advanta, or Paul could sign into his Advanta online portal and submit the invoice to be paid. And then moving forward, all of the $1,500 a month rental income comes straight back into Paul's IRA account, just building up until Paul finds another investment he'd like to make. And again, if that's tax deferred or tax free, depending on what type of account Paul has, that money is either growing tax free or tax deferred. A few other considerations to make in real estate investing. Again, the deed will be titled in the name of the IRA account. It'll look something like Advanta IRA for the benefit of Paul IRA number and then his account number. If you are partnering with another investor, there will be an additional portion that says as to X percentage of ownership, and then the other investor, whether it be an individual, another retirement account, an entity such as an LLC, would be listed as to their appropriate ownership percentage on the deed that gets recorded as well. The IRA in question is only subject to paying the expenses and receiving the income for the applicable ownership percentage. And as I mentioned on the last slide, those expenses can be either sent directly to the client account manager or input on our client online portal to be processed. And the rental income will flow right back into the IRA account directly as well. You would just need to have the tenants mail those checks or submit ACH payments or wires directly to the Advanta account. I see it looks like there may have been a few extra questions coming in. Let me just peruse these real quick. The borrower's entity must own it in its entirety, though. Sue Ellen, if you can maybe chat me to clarify what that question is or statement is, I would like to address it directly. Yeah, so please just message me.
It appears more so as a comment.
Okay. I'm sorry, I did not mean
Are,
to get distracted.
you're fine.
So I have a little bit of Q&A about real estate investing. You cannot get deductions because the IRA account is a disregarded entity for tax purposes. So as much as you may know and follow actual real estate investment outside of an IRA account, this is different, whereas the investment is an IRA investment, so you're not able to deduct losses or depreciate the asset for your personal tax purposes. In most cases, the IRA does not pay taxes on the real estate on its sale, so there's no capital gains or loss taxes to be assessed because it is in an IRA account, which is a disregarded entity for tax purposes. There are certain cases that taxes would apply, as referenced earlier with the UBIT question from Randy. We will cover that in just a second, just making sure that I address that further as well. And can a IRA receive a loan to purchase a property? The answer is yes. There are stipulations that the IRA account must only receive a non-recourse loan, meaning that the lender cannot go after the IRA account owner as an individual or any other assets typically owned by the IRA account, just the subject property that is secured by the loan in question. This does bring into play unrelated debt financed income tax, or UDFI, which is something that was asked about, again, I just mentioned from Randy, UBIT UDFI. Renika is going to cover a little bit more in depth UDFI in her next case study that we'll be going over. But really the thing that I want to point out here and make sure everyone understands is that the IRA account is able to buy a real estate project or a real estate asset with leverage. That leverage must be, again, non-recourse lending. We do have non-recourse lenders on an institutional level that we've worked with in the past and that we could refer you to, or if you have a lender that you're familiar with that is willing to lend non-recourse, you can certainly also put that transaction together, doing your own due diligence, again, as the self-directed account holder and person looking to receive that loan from the lender in question.
Thank you so much, Corey. I do want to reference Randy's question relating to UBIT. So sometimes the term is used interchangeably, UBIT, unrelated business income tax, and then there's UDFI that Corey referenced, unrelated debt finance income. So UBIT, if your IRA or your solo 401k is investing in an actual business, I mean, an investment that's operating as a business, then yes, it would be subject to that unrelated business income tax. However, I mean, how the returns or profits is being sent back to your retirement account. So definitely confer with your CPA or tax professional as it relates to UDFI, unrelated debt finance income tax. If you're looking to use leverage to purchase a property, whether it's in an IRA or a solo 401k, I'll highlight the two difference. In an IRA scenario, you can, it would be subject to UDFI. So for instance, 123 Main Street's out there. You decide that you want to use leverage to purchase. You do have to obtain a non-recourse loan, meaning that you can't personally guarantee that loan. It would be the IRA taking out the loan and repaying it. But let's just say for simplicity, you do have to confer with the non-recourse lenders for their specific terms. But let's just say a property is $100,000. You decide, you know what, even if you have the full amount, but you don't want to put, tie up all of your capital into one property, you put down $20,000 as a down payment. You take out a non-recourse loan for the remaining $80,000 in an IRA scenario. You fix up the property, you sell it. 20% will flow back into that IRA without any tax liabilities because that was the amount that you put down. However, because you use loan, because you use leverage, 80% of that profits would be subject to the unrelated debt finance income. Obviously, as you repay that loan, it's going to go down. Definitely, again, confer with your CPA or tax advisor to help you with mitigating any deductions as it relates to UDFI in an IRA scenario. Same thing in a solo 401k. Again, you want to use leverage to purchase a property. You still have to take out a non-recourse loan, but let's just say you put down $20,000 as a down payment from the solo 401k. You take out a non-recourse loan. You're not guaranteeing that. You fix up the property and you sell it. 100% of the profits will flow back into the solo 401k without being subject to UDFI. So I hope that helps clarify Randy's question. In terms of case study number 2, we're going to look at using finance to buy real estate. So in this scenario, we have Mike. He's looking to do a real estate deal. He has an old 401k that's worth $160,000. He goes out and he works with his agent. He does driving for dollar. Maybe he's part of a real estate group and he found a property that's for $150,000. It doesn't require any repair. It's pretty much ready to go to be rent ready. So again, he has $160,000, but instead of him actually using the full amount to purchase the property, he decides, you know what, he wants to put a portion, $60,000 down from his IRA as a down payment, and he's going to finance the rest of it using a non-recourse loan, just so he can again buy multiple properties. In this case, he's looking to get 2 properties. The details for the loan, in this case, it's going to be a loan of $90,000. It has a fixed rate of 6%, and again, you have to confer with the lender to see what terms that they're offering, what the rates are. In this case, it's 6%, 30-year amortization. He has monthly payments of $540 with annual payments of $6,500. And a few things to keep in mind. Again, Mike is not personally guaranteeing this loan. The only recourse the lender would have would be to foreclose or take possession of the property if the IRA doesn't repay. So as we referenced throughout, the IRA is going to be responsible for paying the actual loan itself. The lender typically, each lender have their own specific requirements, but typically you would see where they require you to have at least 30 to 40% down with cash reserve, just to make sure that you have skin in the game. As it relates to any income received on the mortgage would be subject to UDFI in an IRA scenario. In a solo 401k, not so much. The income, again, is based on the percentage of whatever is leveraged or whatever is purchased. As it relates to the IRS form or filing that's needed, the 990T is required, and you'll be able to, again, this is where you can, in a scenario, can work with your CPA to do those deductions in terms of percentages of expenses and depreciation. If your UDFI liability is less than $1,000, then you don't have to do the 990T filing. And then, of course, as it relates to the taxes, it is paid at the trust rate, so that's considerably higher. It can be anywhere from up to possibly 39%, typically 37 to 39. But again, this is where you always want to confer with your tax advisor. So just an example to kind of outline Mike's scenario. So the impact of using financing and also using a cash purchase. So in this case, monthly income rents of $2,000 per month. With financing, both financing and all cash, the monthly income is $24,000. His loan payments, again, is $6,500. If you do all cash, then there's no loan payment, but again, it's just one property. The expenses related to the rental property is $6,000. Again, you have to maintain it, whether it's working with contractors, or you have to pay a tax-related bill for that property. After you've accounted for your UDFI tax and related to financing a deal, the profit will be the net profit would be $11,500. Whereas if it's all cash, then you receive the full amount. Again, UDFI, you can possibly pay up to 39%. It does vary, but again, the reason I'm stressing this so much, if you have the ability to account for depreciation or deductions, then you want to take advantage of that. In an all cash scenario, then obviously that doesn't apply. And then the total income, minus all of the taxes as relates to UDFI or any other miscellaneous. In this case, he had his IRA in this case got back a little over $9,500. In an all cash scenario, it's $18,000. But again, Mike ended up with 2 properties. So he used his funds to his $160,000 to end up to purchase 2 properties as opposed to 1.
So the next case study that we're going to go into is utilizing checkbook control. This kind of ties back into the question from earlier, and I will specifically go over how it relates and applies per Avis's question. So utilizing checkbook control is a way for you as the client account holder to get direct access to the funds in your IRA account. There are certain investment strategies clients utilize. One of the ones that comes off the top of my head is going to a local tax deed and lien auction, or even a general real estate auction at your local courthouse. Those types of investments typically require you to have cash in hand, which you're not going to have with Advanta serving as the account manager and maintainer of the account. So checkbook control is a strategy that allows you to set up a single member LLC, whereas your IRA account is the member and you yourself are typically the manager of that LLC, or someone that you appoint as the manager can also be that person. You would set up a basic checking account in the name of the LLC and send whatever portion of your IRA money you would like for that investment strategy into that LLC's bank account. And moving forward there and after, you can cut checks and process transactions via a debit card or a checkbook, wiring from that bank account directly for that investment strategy. One thing to keep in mind is that when you do set up checkbook control, Advanta is no longer paying the bills and processing the day-to-day transactional expenses and different items for the investments you make within the checkbook control. So it's imperative that you follow up with your client account manager if you have any questions, concerns, or issues with some of the strategies you're looking to do, because we're not a big brother per se, whereas we can't see everything you're doing within that checkbook control account. So it's tying back to your own responsibility and due diligence to keep up with that IRC tax code 4975 for your rules and regulations and different investments that you'd like to make. As far as how this ties into a multi-member LLC, these LLCs can also be set up with multi-members. They don't have the exact same as a single member checkbook control, but you can set up a similarly constructed LLC with more than one IRA account or more than one investor to pool together to purchase any type of investment or subscribe into a syndication. How a checkbook control works, how a checkbook control works is that the individual, in this case we've got Joe, creates a Advanta IRA account, transfers or rolls over funds from his existing IRA or 401k, and then is issued an account number. He can then take that account number to either set up himself or a CPA or tax preparer. We do have some referral sources for you if you're not familiar with setting up your own LLC, but he would just need to go get an operating agreement put together, get a tax ID number registered from the IRS, and then once he has it articles of organization as well, he can go ahead to any bank of his choice and open up a basic business checking account. And once the funds come over from that transfer or rollover, we can then fund the transaction to move the portion of cash Joe wants into that checkbook control LLC. And again, as it shows here, the member of the LLC will be the full name of Joe's IRA account, very similarly to how you would take title of a piece of real estate directly using a checkbook control LLC, or the IRA account directly buying real estate through Advanta. So when you're actually moving money from the LLC or trust account, another strategy very similar to the LLCs would be setting up a land trust. It functions a little bit differently, but in the same capacity of taking title of the investment in that trust or that LLC rather than directly through the Advanta IRA account. But again, what I'm trying to get at here is that these types of investments, when you make them, for you to actually receive the money back as a distribution or to utilize for another investment, you would have to send the money from the LLC or trust back to your Advanta account, so back to our company, so that we can then process either a distribution to yourself if you're looking to move funds to a managed account where you could invest some money back into the publicly traded assets or things like that. That does have to come back to us so that we can do the proper tax reporting. It would be improper and create a issue if you were to take money directly from the LLC and go move it directly into another IRA account elsewhere, or take personal ownership of that money out of the LLC's bank account to use for any anything else out of your personal needs or requirements. So it's important that I stress very seriously, the money in an LLC is specifically to be utilized for the IRA accounts investments. Anytime that there's a pool of money that you'd like to utilize for something else, that money must come back to Advanta from the LLC or trust before it can be utilized for a distribution, a transfer out, or any other purpose. Before I jump into the next slide, I don't have any specific slide covering it, but I did want to go more in depth into Abbas's question about investing into real estate directly with someone that would otherwise be disqualified, or doing it through an LLC. So the main difference is when you invest into the real estate directly through the Advanta account, so Abbas, your IRA account taking title to a certain portion and your family member taking title to the other portion, you would, on a case-by-case basis, need to have the expenses cut whatever portion is applicable for your IRA account, and then whatever portion is applicable for your co-investment family member would have to pay those on a case-by-case basis. Whereas if you set up the LLC, you really only need to differentiate those funds, because it's all just the LLC's pooled money at the time that you're looking to take any distributions out of the LLC once you've started to earn money on the asset in question. Or if you need to add more money into the LLC, let's just say a major expense comes up, like a roof needs to be replaced, or any type of major expense you're looking to tackle. If you need to move more money into the LLC, it would need to be moved at the same ownership percentage. So if you're splitting the property 50-50, or in this case, splitting the LLC 50-50, and you need $10,000 more, that means $5,000 has to come from your retirement account, and $5,000 would have to come from your co-investment partner. It does make it a little bit easier in some cases to do the LLC for this type of real estate investing, again, because it makes it so you only have to send one check to a vendor when an expense comes up and you're receiving the income. You don't have to tell your tenants, hey, half of the income needs to go to this entity, half of the income needs to come here. That's also can be mitigated by use of a property manager. And again, if you have any further questions about that topic, Abbas, I would be very happy to speak with you on a separate conversation after the session, just to go over any specific questions or concerns you have about that strategy, or comparing and contrasting those two options.
Corey, if I can interject really quickly, I saw another question came in. I want to catch it really quick. So
Sure.
The question is, going back to investments, if you invest in a syndication as a limited partner with your solo 401k, and the syndication uses leverage in the solo 401k, is the solo 401k subject to UBIT or UDFI? That's a great question. So just keep in mind that certain income, such as dividends and interest, or maybe royalties or rental income, is actually excluded from the UBIT tax. So it's very important how that actual syndication, how that company is structured, and how they're sending the income back to you. If you're just a passive investor, then if it's coming back as dividends or interest, then your 401k would not be subject to that UBIT. So it's really important to find out from the syndication how are they're structured, and how are they sending the funds back to your account. So in terms of, again, just to kind of highlight the key takeaways from today's presentation, again, just knowing that any type of IRA qualifies to be self-directed. So whether you have a 401k or you have an existing IRA elsewhere, you can move those over to self-direct. 2, you get to choose the investment that works best for you. So you're always in control. You get to decide what works best, what you want to invest in, whether it's real estate based, or it's investing in an LLC or a private startup company. And then, of course, again, knowing that all of the expenses are paid by the IRA, all of the income from that investment will flow back into the IRA if the IRA is the only party involved on the deal. In terms of getting started with us, we've really streamlined that process for you in 3 simple steps. So first and foremost, you would go through the process of completing the application. That can be done electronically via DocuSign. You'll have someone like myself or Corey there to walk you through the application to get your account open. Step 2 is funding your account. So you have a couple ways you can do that. One of which is if you have an old 401k, you can do a direct rollover where you actually initiate that request. If you have an existing IRA, you can do you can transfer as much or as little as you need to make the investment. Advanta, as the administrator, will actually initiate that transfer request in your behalf to move those funds, or you can make an annual contribution in accordance with the IRS limits for the account type, or you can use some combination of all three. And then finally, step 3 is just, start investing. What is it that you're interested in? Let me just really quickly see if there's any final questions. So in terms of fees, we charge a flat administrative fee. Definitely feel free to reach out to us directly, and we can kind of go through all of the key main fee structures, but it's a flat administrative fee. We don't charge any commission or anything like that. I just want to cover and see if there's any other questions that came in. Again, I really appreciate everyone taking the time to attend today's webinar. This is recorded. It will be uploaded onto our YouTube channel within 24 to 48 hours. If you have specific questions or you want to do a deep dive into your specific scenario, feel free to reach out to myself or Corey. You can, call us. Our contact numbers on the screen. Give us an email, send us an email. We'll be happy to assist you. Let's just kind of go through any last questions. I think that covers it. Thank you again, everyone. We really appreciate your time today.